Morning, Lucy.
Good morning, Lucy.
Good morning.
All right, so I think we should get started. I want to respect everyone's time. So I want to say good morning and thank you for joining us. We're excited to welcome you to today's virtual event. My name's Toreen and I am the events manager at CIA&J. And today's session is all about how business owners can save on taxes using the right strategies. So this event will run for about an hour. We will leave some time for questions at the end, but if you do have questions during the event, please either raise your hand or you can put your questions into the chat box. And today's session is also being recorded, and we'll share the recording with everyone afterwards. So we're happy to be joined by our two expert speakers, Nick Agharkar. He is the attorney and owner of Crown Point Tax and Wealth Counsel, and Lance Rothenberg, the founder and principal at Rothenberg Tax Law LLC. So let's dive in and get started, and we'll begin with Nick.
Hello, everyone. So let's see. All right. Welcome. We are two attorneys that are friends, and we operate on two sides of the same coin. So my name is Nick Agharkar. As Trine said, I own Crown Point Tax and Wealth Counsel. We are a strategy firm. So primarily, our firm provides guidance and strategy to small businesses on things they can do to save on taxes. We meet with our clients regularly, making sure that they're implementing these strategies. We also have accountants on staff, and I will let Lance introduce himself as to what he does.
Good morning, everyone. Thank you, Nick. My name is Lance Rothenberg. I am, as Nick said, I'm a tax controversy attorney. I have my own law firm in Morristown, New Jersey. Most of my prior career, I was at large law firms doing state and local tax and tax controversy. And then I was, for the accountants in the room, I did a healthy stint at Cohn Resnick, where I was in the state tax department, the SALT department, advising the firm's clients, and also on the controversy side. And what I do is all mix of breakdowns. Like, so why Nick and I thought this would be a fun program to partner together is he does a lot of advising and planning. I do some of that, but more of what I do is when things aren't planned properly, or when the IRS or a state comes along, kicks the tires, wants to make sure things are done correctly, I handle the audit defense or some other inquiry collection defense breakdown. So there's a lot of information today. We'll try and get through some of it. It's a small audience today, but we can, entertain any questions you have. So feel free. And if we can't get to something, we'll try and follow up with you afterwards.
Yeah, and on that note, as Lance said, we are a small group. So if anyone has any questions, if you hear something that you want to hear more about, just let us know. So at first, the legal part. We are attorneys, as I say to people. I say to my friends, while I am an attorney, I am not your attorney. We are not we are not forming any attorney-client relationships today. All of this is just for informational purposes only. This is not legal advice. If you have a specific question, we'll feel free to consult with us, but we won't be answering any specific scenarios on today's call. We want to just stay away from giving legal advice. So there's our disclaimer. So Let's talk about sort of overarching kind of why we're here. Why are we talking about this stuff? Look, tax strategy is super important. And if you're on the internet at all, there's loads of people out there pushing different kinds of strategies, things you should do, hire your kids, buy a G-Wagon, business travel, all of these different strategies that, while legal and can work, can also come with dangers if you don't know what you're doing. And so that's why Lance and I are teaming up here. I'm going to give some high level introductory information on some common strategies business owners can use to save on their taxes. And then Lance is going to take that flip side of that coin and explain what happens when that strategy goes awry, if you don't use it correctly, if you don't think about compliance or documentation. So why tax strategy matters. The first thing I always talk about to folks is the timing of when you pay your tax matters. Coming from a W-2 background, which a lot of small business owners do, you're used to getting your paycheck and your taxes already taken out. Then you have to pay expenses with whatever is left over. Business owners have an opportunity to reverse that in a really powerful way, where they can pay expenses first and then taxes last. As I mentioned, though, documentation is key with any strategy. Anytime you're going to tell the federal government, no, no, this isn't income or this isn't taxable income, they're going to probably want some sort of backup, right? You're going to need that documentation. You need to be able to prove that what you're saying is correct and that you have the documents and the evidence to show that. One of the big things that I work with my clients on, and one of the things I've coached them on through the years is do not come to me in November asking about all these different strategies that we can implement. This makes things incredibly difficult. There's only a month or 6 weeks left in the year to cram in as much of these savings as we can. Planning quarterly, I would say, is a great first step. Even planning monthly might be something you want to do in your business because this is throughout the year. You are currently planning for that filing season in April of 2026. So, what moves are you making this month that are going to impact that tax bill at the end of the year? You always want to be thinking about tax because these can really, just a few of these strategies combined can save hundreds of thousands of dollars on your tax bill. So let's jump right into why compliance matters here and the documentation. So Lance, take it away here.
Thanks, Nick. Yeah, like I said, I handle some planning more on the state tax side, and that's an opportunity for me to really add value to for the things that Nick is talking about, we're going to talk about now. But what I largely do is I'm brought in at the end by the taxpayer, the business owner, the accounting firm, saying, "Hey, this audit is going on. It's going sideways. We're getting, we're running into roadblocks. We're getting aggressive responses from the state tax auditor or the Internal Revenue Service auditor, And at that point, like Nick said, coming in at November, it's a little difficult. If you had thought through these things in advance before the auditor sends that letter, you're going to have a much better opportunity to get the outcome that is going to be better for you, right? What you were trying to accomplish all along. So I always tell everyone, again, it's a little too late after the auditors come knocking, but the best offense is a good defense, right? So that means going to your first having advisors, right? So depending on where you are in the life cycle of your business, you're getting large enough to a point you should start looking and bringing on outside experts and advisors, bookkeepers, accountants, financial advisors, attorneys, and so forth. And at that point, you can then start to structure the business the right way. Think about, is it legally set up correctly? Is it operating correctly? Is it turning a revenue? But then how do I do things from an efficient standpoint, a tax efficiency? And that could be crossing a multi-state line or just structuring yourself in the right way. So, I'll leave a lot of that to Nick. But if you don't do these things, it's going to be very complicated. It doesn't mean that you're going to go to jail, and it doesn't mean that you're going to lose your business, but it could in the worst case scenario. Because again, what are we really talking about at a high level? All taxpayers, whether it's individuals, businesses, we have an obligation to pay, assuming you're in a jurisdiction that has an income tax, you have an obligation to pay income on your profit, right? If you're talking about sales tax, you need to be collecting that from your client and then properly accounting for it, properly reporting it. If it's payroll tax, if you have employees, you need to be registered. You need to be withholding it. It's a trust fund. You need to be turning it over in the right timing. So there's different taxes, there's different jurisdictions, there's different governmental agencies. Everybody at some point is focusing on something. And so, I tell my clients, the wheel's going to land on someone. At some point, it's probably going to land on you or your colleagues. So it's a good thing to be thinking about these things in advance so you can line them up, so you can understand why it is, why you did what you did, why your documents say what they say, what the tax return is reporting. Can you support it? Do you understand it? Again, a lot of this stuff gets complicated, it gets esoteric. So, that's why you have advisors. It's their thing. You're running the business, whatever your business is. But you do have an obligation by the law, and the Internal Revenue Service or the state of New Jersey, the state of New York, whomever is going to expect you to have some understanding of how your business is in compliance with whatever these obligations are. What is it doing? So you're not going to be able to just say, "Hey, I have my bookkeeper. I had Nick, and so you got to talk to them." You can delegate certain responsibilities, but other things you just can't delegate away. You own a business that has responsibilities. You're going to have to keep the paper for the requisite amount of time to show, again, that you actually paid that expense, that expense was reasonable. All these kinds of things that Nick and I are going to talk about. But so what this slide was trying to do is let you know that it's not overly bleak, but there's a lot of obligations, and you really do have to sort of educate yourself and surround yourself with a team so that you can make sure you're complying with all these rules. And again, as we go through some of these things and we talk about some of the cases where some of these strategies break down, you have to keep in mind there's lawful planning. So, the Supreme Court has said you don't have to pay any more tax than you're obligated to, right? So that's our American right, correct? But then there's a continuum of where you make mistakes and where or maybe the government is just coming along kicking the tires and maybe took an aggressive position, and you have to now fill in the gaps and explain it to someone who's not inclined to believe you, like you and your business owner or your accountant were at the time that you took that position. Or maybe records were destroyed. Maybe there was a fire. Maybe there was a flood. Maybe someone moved. Someone maybe passed away. So, you've got gaps in your record keeping. And now you have to figure out, well, someone's asking questions. How do I answer that? So that kind of non-compliance, that happens every day to any given business. Someone like me is always trying to kind of solve those problems. And then on the last side, not to scare everyone, but you can actually run into a situation where you have knowingly violated the rules, or you've done something that was so aggressive or so unprincipled that someone could say, "Hey, you've committed fraud, you've committed tax evasion, you're going to face criminal prosecution." So there's a whole cadre of white collar criminal attorneys. I do a teeny bit of criminal law. I refer that stuff out. But where you have those kinds of things, if you're taking those kinds of risks, or at least be aware that these obligations and these prosecutions are lurking out there if you're not filing correctly, you're not doing the right thing. So again, not to overly scare people, fraud is a high burden. But if you're keeping two sets of books, I think we probably should have a conversation after this webinar. Nick?
I mean, one of the things I want to call out here on this slide, right, is that image in the top right. When I was starting out in tax, the IRS website was one of my best resources. It provides a host of guides and information, publications, circulars that are, for the most part, written in plain English. But the best part of a lot of these guides is the IRS produces examples, and they give you scenarios in which they tell you what the outcome would be. This is extremely helpful. So if you're just interested in this kind of stuff and just getting a little bit of education so that you can work better with your advisors, I think Lance feels the same way. I love an educated client because then they understand what's going on. We can really work on that same wavelength of, okay, well, here's what's happening. We know why. And you're able to work with your advisors in a lot better and a lot more impactful way, I would say.
100% on both of those points. One, client that understands or has taken a little time to understand these obligations is just going to appreciate the role of the advisor more. And, because a lot of times we're sort of giving the bad advice, you're making them do the thing they don't want to do, or come up with, records to support something that they maybe would rather not talk about. But if you are trying to understand how to run your business correctly, because again, someone's getting audited every day of the week, whether it's by the state or the Internal Revenue Service, you can do these things, by hiring someone, or you can do this stuff on the cheap. Just go to the IRS website, go to the Division of Taxation in New Jersey's website, go to the New York Department of Tax website. These agencies want you to comply. So they're putting out a lot of information that, as Nick said, it's not always, but often it is trying to be in plain English to explain it in a way that a business owner who's not tax savvy can understand these rules. You're still probably going to have questions, but you can give yourself a nice baseline of what is expected of you as a business owner or as a taxpayer just by looking at the form instructions or just going to some of these publications. So good point, Nick.
Yeah, yeah, and so let's sort of move on to the sort of some of the strategies, right? So the way that I'm going to talk about this is not necessarily prescriptive, where oh, you should try some of this stuff. We're going to go over some of these strategies, and again, there's a range here, right, between being extra conservative and being ultra aggressive. It's not sort of black or white. There is a spectrum of levels of aggressiveness that you can go after some of these strategies, where you have to figure out where you're comfortable. But the top line here as to why a business owner is going to do better than any W-2 employee is, again, as I mentioned initially, when you pay taxes matter. So business expenses come out of your gross monthly income, right? Which is very different from an expenses and living expenses and after-tax income for a W-2 owner. And we notice here in this chart, right, it's a basic chart, that the net income for the business owner is quite substantially more than the net income for the W-2 employee, because they were able to do a lot more with business expenses. So what's a business expense? The code defines it as an ordinary and necessary expense for your business. Ordinary in that it is usually what people in your industry spend on. Necessary is that it was necessary to further your business interest, your profit motive. So as we see, business expenses, that's kind of a broad definition. What can we fit in there? Well, the IRS certainly already allows you deductions for meals, travel, your car, your mileage, a home office. These are things that are baseline. Well, can we extend that? Well, yeah, sure. When you traveling is a completely different thing. When you're traveling more than 100 miles from your home for business, all of those expenses are covered, right? You get a per diem effectively. You get your meals covered, your lodging, your airfare. Okay, so as I mentioned, there's this level of aggressiveness that you can get at, right? So I have some clients that are very comfortable with planning that family trip to the Maldives and setting up time there to have it, to do a talk, do a board meeting, have meetings with people that will maybe open up a new business there. But making a business purpose out of every day of your family vacation can actually turn that flight and hotel and maybe some of the meals into business expenses. And in this way, what you're doing is effectively you're paying your expenses before your taxes. This nets out in a greater income to you because, again, you've already taken that vacation. You paid for it through the business. I have other clients that are even more aggressive, right? And they want to employ their kids. And we're going to come to that strategy in a minute. And they get them a license in the business. And then they go to college for marketing or for business. And they run the college tuition expense through their business. Is it a business expense? Arguably, you could make the argument, right? It depends on the documentation. It depends on a lot of factors. But in these examples, this is, again, another example of just how aggressive do you want to be? You can get pretty aggressive in terms of what a business expense is. But again, documentation is key, and understanding the nuances of each of these rules and rulings is important. And so on that note, I'll turn it over to Lance to tell you what goes wrong when you get too aggressive with your business expenses.
Thanks, Nick. Yeah, again, keep in mind there's strategies and then there's strategies, right? And by that, what I mean is you're filing a tax return that is reporting whatever it's reporting, and it's going to go into the hopper, and the IRS or the state or maybe the Department of Labor, some agency is going to end up looking at this, or probably looking at this, and is going to have questions, right? They're going to screen it and say, does everything look right? Should we take a deeper dive? Should we, pull this for exam? And if they do that, now you're going to have to really kick the tires on the strategy that you've implemented. Did you do the right thing for the right reasons, and can you support it, right? So, as Nick was saying, is something really deductible? That is something that any tax auditor is going to really take seriously. It has to be an ordinary expense for your type of business. It has to be necessary. There's definitions to these things. We can save that for another time. But again, it can't be willy-nilly. It can't be personal, right? It has to be something that is advancing the goals of the business. And then you get into these disputes, and I've handled a lot of these where the question, first and foremost, is it an expense that's deductible? But then you get to this earlier question: is the activity itself even a business? Right? If it's a personal hobby, you don't get to deduct anything. It's just a leisure pursuit. If it's a business, then if those expenses are appropriate to that type of business, then you can expense them and so forth. But whether something is a hobby comes up, and it comes up more often than you would think. I've had a number of business. I had in New York, I had a brick and mortar grocery store, a small sort of boutique grocery store, but something you could imagine in Brooklyn, where they were not turning a profit. They were losing money year after year. By the way, the years happen to be 2020, 21, 22, which what does everyone remember was COVID, when things were in urban centers were down. So anyway, this business wasn't turning a profit, and the state came and said, hey, we think that you're a hobby, essentially, and they disallowed the deductions. And then they had to go through an appeal process where we were able to convince them, look, this is a brick and mortar store, actual inventory, actual payroll, actual sales tax receipts, actual lines of insurance, blah, blah, blah. And we were able to win. But these things really do come up. So, and furthermore, whether you have that inquiry or not, and you have to navigate it, another line that you're gonna have to go through is, can you substantiate the expenses? Did you actually pay the expense, in the amount that you claim? Do you have the paperwork to support it? And maybe not just the credit card receipt, but the actual invoice or contract or statement of work. That's what I and many of my colleagues do. We're always asking for paper because the paper is what's going to convince an auditor, hey, you don't have to have perfect 100%, but you're going to have a decent amount to establish that what you did was reasonable, that what you did for this period or this transaction was probably, that business practice of keeping things and doing things correctly would apply to other transactions or other periods. So you're going to have to show that you're a good steward, that you're a good taxpayer, and that you can answer the question when it's asked. And also don't forget, and this gets a little technical, but in an exam, in a tax audit, the burden of proof can switch a little bit, but generally speaking, the burden of proof is on the taxpayer. And regardless of what the legal standard is, as an actual matter, as a practical matter, it's always going to feel like it's on the taxpayer, on the business owner, right? So when the auditor is asking questions, you're going to tell me, and you're going to say to your friends and colleagues, this person is crazy. They're asking all these insane questions that's over burdensome. But probably it's not. Probably they have the right to ask it. Probably you have the obligation to answer those questions. You probably have the obligation to have all the paperwork that they're asking for. So you really need to understand that these are not. I always tell my clients, the auditor is not your enemy. They're not your friend. Their job is to do their job correctly, to see if what was reported is correct. Can you answer their questions? But again, they're not their enemy. They're by and large, they're decent people just trying to do their job, just like you're trying to do your job, and their job just happens to be adverse to you, right? And on this issue, but it doesn't really have to be hostile as long as you did things correctly. And if you had some foot faults, that's where you can strategize and think through it a little bit, how to present that the right way. But oftentimes, again, every situation is different, but oftentimes candor can really get you through a problem and say, hey, we don't have that, but we have this.
And here, Lance, just to jump in here, on my side of the street, right, doing the strategy and the planning, and I do some small bookkeeping for clients as well. That's critical. if you don't have someone in your QuickBooks or your books on a regular basis, especially if you're going to pull off some of these strategies, right? It's not like you don't know. It's not like you don't know that you're going to try and claim these expenses. So if you're going to try and do this, it really is keep up with it, right? Keep up with it in contemporaneously, because the worst thing that can happen is these audits, they don't happen, we just filed April 15th, right, for 2024. These 2024 returns, they aren't going to come up for audit to probably 2027, 28, right? So
So at least two, 3 years later. Yeah.
right. So you need to make sure that you've got those records cold, right? Already done when your taxes are filed, because when you come back 3 or 4 years later, I promise you, there's no way that you're going to remember accurately to a point where Lance is going to feel comfortable presenting that kind of information. So here's a little plug for bookkeeping. Make sure your books are up to date and current, not just for your own sort of understanding of where your business is, but for the evidence that you might need when you're going to claim these kinds of deductions.
Absolutely. And that's a good
Sorry,
segue.
sorry, Lance and Nick, I just want to chime in.
Oh, Nick.
We do have a question here, and I just want to let everyone know that if you do have a question, you can take yourself off of mute. This is from Lucy Sorrentini and Debbie Barnett. Does this scenario vary for LLCs versus S Corp and the requirement to make quarterly tax payments?
So everyone should pay their quarterly taxes. If you have a business, pay your quarterly taxes. I'll just say that sort of as a blanket statement. An
Absolutely.
LLC is an S corp, and an S corp is an LLC. So one of the common things that I work with clients on is they think that making an election for an S corp somehow changes their entity. It doesn't really, right? Your entity is still an LLC. You're just being elected to be taxed as an S corporation. And that I don't know if we have a slide on that, but really the thing that it does for you is that with an LLC, when you take distributions, that distribution is subject not only to the 15.3% self-employment tax, but also ordinary income. So basically that distribution is getting taxed twice. Now, if you set up an S corporation with payroll, right? Now, payroll takes that self-employment tax. So whatever you pay yourself is the only thing that gets that self-employment tax. And any distribution you take then is just ordinary income. So in doing this and electing to be an S corp and setting up payroll, you save on that self-employment tax effectively. So that's how that all kind of fits together. But one key understanding here is that just because you elect to be taxed as an S corp does not suddenly magically change your entity structure or somehow you need a new operating agreement. Your LLC is still your governing structure, and that operating agreement is still your governing document. Does that answer the question?
Yes, it does. Thank you. I'm going to add a follow-up question. And if it's too specific and advisory, we can maybe talk offline. What about the scenario where, in my case, I am an S Corp W-2 employee on the S Corp, right? And if I remember the summary that you had before, when you're W-2, I saw a higher tax base or tax impact versus the other scenarios business owner. So W-2 S Corp CEO, who's also a 1099 board director. Does anything shift at the highest of levels or any high level considerations that are different from what you've said so far?
No. So you're a 1099 board member of your own company or of a different?
No,
right,
of a different company.
Right?
Mm-hmm.
So no, and actually, you can actually open it up to a place where if you feel comfortable, right, you kind of have two businesses, right, in which you can run two expenses, right? So if you have expenses related to your board activity, right, that can count as business expenses, right? So, again, I want to stay away from sort of specifics, but
Sure.
no, the difference, the chart that I was showing before, we can go back to it. Let me see here. So the chart that I was showing before, right? On this side, the W-2 employee is not a business owner at all, right? This is just strictly an employee. So this is just someone that you hired to work for you, right? The business and the owner, right, can also take a payroll, right? And I encourage that, especially in my S corp. But they also get those distributions, right? And the distributions are then taxed at ordinary income. So that's kind of a different topic. It's related but different, right? Because your payroll is also still a business expense. So you get to expense the payroll as well as then not take the 15.3% hit on the distribution as well. So we can walk through that. That's a different, a little bit of a different topic, but that's kind of what we are. Sorry, Lance, I've hijacked you.
No,
Thank you.
that's right. Let me jump in on that because one thing that's really important. I think we should make clear too, is in an S corp, you have to take payroll, right? A lot of people think, oh, I'll just take this election and then I'll save on the self-employment tax and it's amazing. But the IRS and the states want to see that the owner is taking reasonable, what's called reasonable compensation. And you can have debates about what reasonable means, like everything sort of we're talking about here. But you have an obligation to make sure that you're taking payroll. And if you're not, which again, I've seen a number of instances where some scenarios come across my desk and the S corp owner is not taking any compensation, they're just taking distributions. That's a major problem. Again, doesn't mean you're going to jail, but you've got some explanations if anyone asks those questions. So make sure you're taking what's called reasonable comp.
Yeah, and not to go too far down the rabbit hole, but with payroll, then you need to find a company to do your payroll that actually knows what they're doing, right? I've seen it too, where, business owners set up a 401k plan and they tell their payroll company to take care of it and they don't. Not contributing to a 401k plan is an ERISA violation. It can be, right? So this can be a serious problem. So that can come with a lot of federal consequences. So it's really important that if you do make an S corp election, don't try and do payroll by yourself. Get a good firm that does payroll, right, and can actually understand and work with you on what you're trying to do.
Yeah, and not to hijack our own thing, but with payroll, again, sales tax and payroll, I handle a lot of these issues.
Yeah,
they're trust fund taxes, and so they're sort of the magic bucket of category when an auditor is looking at this. So if you're dealing with your employees' withholdings, right? To Nick's point of getting a good payroll company, if you're trying to do this yourself and because what happens is businesses sometimes they get, I have to tell you, you get into a cash crunch and you think, geez, I got to pay this vendor, or I don't have product to deliver my services, whatever your business line is. So they say, well, I'll dip into the sales tax account, or I'll dip into the payroll tax account because money's money and I just have to, I'll move from one line to the other. Well, now you're shorting the payroll for the IRS, for the state, the sales tax for the monthly payable. Now you've created, one problem has become two problems, could become three problems. And these trust fund taxes can become personal liabilities of business owners. Of a responsible person is a whole other area we won't get into, but you can take a corporate liability and a corporate problem and make it an individual problem by messing around with these things. And again, people are still going to borrow, but if it's short term, maybe you can fix it. But what happens and what I see is 1 month becomes 2 months, becomes 3 months, because the business has cash flow issues, and you start taking, and then you've got major problems.
Because then the penalties and interest too. I mean, that's the problem, is that what people really don't understand is there's no way around the interest. Penalties, Lance and I can talk, and make a good story around, but there's no getting around the interest. You owe, the interest starts running, and interest rates are not low. So it can get really hairy very quickly.
Yeah, it's a time value of money issue. So if you owed it and you didn't pay it, then it's the rate. And again, they are, this is where the sovereign makes the rules. They charge a higher rate of interest on underpayments than they pay you on refunds, right? So it's not a good game to play if you don't have to play that game. So enough of that. Let's go back quickly to these business expenses, because I just want to bring up the case on the slide, because it's kind of a fun case that highlights the point. Again, this is a recent U.S. tax court case where a taxpayer was audited by the Internal Revenue Service, and he was a musician in California, and he traveled around to different venues and so forth. And he claimed on his returns appropriately, he claimed travel and mileage expense because, again, he was traveling for work. However, he lost a lot of his records in I think it was a fire. He also didn't keep a simultaneous log. You're supposed to be documenting this that day, that week, but certainly that quarter, right? That what you're doing. So you've got good contemporaneous records. Unfortunately, he just didn't do that. But when he did get audited, he reconstructed these records. And again, it made sense. He's a traveling musician. That was verifiable. He did travel from point A to point B. That was verifiable. So he got a good portion of his mileage expense, but not everything that he probably traveled, because he didn't have good records to begin with. So he lost money by not doing this, right? That's the important point. By not doing these annoying things, you're probably going to end up shorting yourself. On on the more interesting issue, because again, Nick is saying sometimes people can take these things too far. Well, he traveled to Japan, and he claimed that, and maybe he was, I don't know, but maybe he claimed that he was really interested in the music scene in Japan, and he ended up deducting the entire cost of that trip on the returns. Well, the IRS allowed most of the mileage for his performances in California, but they looked at this and they said, "Hey, you didn't make any income for your trip to Japan. You didn't have any contracts in Japan. You couldn't really articulate a business purpose for this trip. So at best, if it wasn't just a pure personal vacation, at best it was exploratory, and not actually yet a business expense. So those things were all denied. So what happens when you deny it? Well, now he owes the back tax. We just covered he owes the back interest. He also I think he filed his return late, so he had penalties. He's not going to end up getting out of the penalty for the improperly taking these deductions. So what could have just been, just take the hit on the return at the time became a bigger tax bill simply because he didn't do things correctly. And this was fairly low hanging fruit, and he just, this taxpayer just messed it up. And that thing happens all the time.
And again, it comes back to documentation, right? So we'll move on because we're trucking right along here. So to the next strategy here. Again, you may have seen this on TikTok. Hire your family, right? Hire your kids. Put your kids in the business. It can save you money. Magic, right? Be very careful. So is this legal? Yes, it is legal, right? So I've put the code sections there. There's no specific code section that says, yes, you can hire your family, but these are all the code sections that go to basically hiring employees and how this can work. And we see the example in the chart, right? And so this assumes, parents, they own the business and they have 3 kids. Now, if they took the $30,000 from their income and distributed it to the children, right? Now, each of the children worked in the business, and this is critical. They worked in the business. They did something. They have to do something. If you're trying to employ your 2-year-old, it's probably not going to work because they can't do anything, right? They can barely feed themselves. So we have to make sure that we're being honest, forthright, and actually doing these work, right? I mean, I've talked to business owners and talked to even their college age kids, and I've explained to the kids, hey, you actually have to do something. And the kid says, I don't want to do anything. All right, well, then this strategy is not going to work, right? So everyone needs to be on board. There has to be good communication. There has to be an idea that this is what we're doing as a family to all of us save money. And as we can see here, because you're paying the children less than where the marginal tax brackets start, they don't pay any tax. They pay no tax. But guess what? Now that they've had earned income, they can also go ahead and open up IRAs. So this can be a really powerful strategy because you can basically set them up for retirement now when they're still children, put that money away, save yourself on taxes. You can see you're saving about $3,700 on your taxes just by shifting $30,000, right? Now, if these are older kids and they actually want to work in the business, you can continue to shift even more of your income. And now you're paying a lower effective tax rate. You're setting up your kids for retirement. And everyone is happy, right? Because even this too, I've used this strategy with some clients who want their kids to pay for more of their own college expenses, right? They want to stop paying for spring break trips and nights out at the bar. So they give their kids basically this income so they can finance their own lifestyle and they can live off of what the parents are effectively making, and everyone pays a lower tax rate. But the key here again is you've got to pay them a fair wage for what they're doing. Keep proper documentation. Again, this is where absolutely we come back to this over and over again. You've got to have the evidence that this is a reasonable and or necessary business expense. It is ordinary that these people are working in your business. And it can create also, you can then also create health care benefits, right? Because you can put them on as employees on your healthcare plan, which is again another business expense. And again, remember, business expenses come out after your gross income. So in a lot of these this sort of in this way, hiring your kids and hiring your family can combine a lot of different powerful strategies to save you on taxes. Especially because all of this comes back down to what's a business expense. It's all a business expense if you're paying your kids. So how could this go wrong? Lance, take it away.
So yeah, you have to understand again, these scenarios get closely scrutinized for good reason, right? There's a lot of opportunity for shenanigans, I'll say. So, but there's also, it can be completely and entirely proper and appropriate, but you have to have done it correctly. So, like Nick said, make sure you've got, an actual position that's the child or the family member actually performs, pay them a market reasonable rate, file, comply with whatever rules are out there, file the payroll returns, issue a W-2, have consistent records. Everything you could boil this whole presentation down to have good documents, right? But again, it's so true for this scenario. And so we'll just quickly, because of time, we'll look at this Fisher case from 2016. And there's more recent cases, but I like this one because I think when I explain it in a minute, you'll appreciate the humor. So you had a solo tax attorney who had 3 children, all under 9 years old. And she would, during summer vacations and other times when the kids weren't in school or in daycare, she would bring the children some of the week to school to work with her. And she then paid them around $10,000 claimed on the return per year for the 3 kids, which they put into the kids 529 plan, which again, Nick said, you can do some of these things. And later in another case, which we'll talk about later, that they're putting into a pension plan, a 401k. But in any event, this was challenged, right? No, you're listing right on your return the ages of your dependents. So they're little children. Are they really properly working at that level in a law firm? I have young kids. I wish I could do this, but the answer is no. So this person said, hey, they were doing paper shredding, they were answering the telephone, they were doing light photocopying, they were greeting clients. All of those things actually make some sense. A 9-year-old probably could do that. I don't know the ages of the other children, but perhaps. But this person, they didn't file the W-2, they didn't do the payroll records, and then they couldn't articulate. Look, there was no log of hours that this person was doing. There was no really good description of what each child was doing. Just sort of the children in the group were doing this work, so it wasn't broken out in a business-like manner, right? So what the court ultimately did is they said, look, we believe that your law firm is a real law firm. We believe that the children, arguably did something. So it gave a nominal deduction of $250 per kid per year. So this is an example to prove that you can actually employ your children, but you have to do it reasonably. So I think, again, I wasn't involved with this case. I just read it. But I think they were pretty lucky that the court gave them the $250 at all. But it does demonstrate that you can properly do these things. And they probably could have paid them more had they set it up correctly, met with someone like Nick and done it correctly and then lined it up. They probably could have gotten something much greater than $250, probably not the $10,000 that they were claiming.
Yeah, I mean, I tell people, if you've seen it on social media, so has the IRS. So these kinds of strategies, right? They're rampant, right? They're all over the internet. They're getting a lot of play because they're clickbait, right? It's exciting, right? Oh my gosh, I can save so much money on my taxes. The thing to understand is that the IRS sees that too, right? They're online as well. So if you think that, oh, I can get away with this because it's this, interesting strategy, and this person online said it was little known, so maybe the IRS doesn't know about it. They know, and they absolutely are watching. So, if you're trying any of these exotic strategies or going to think about being aggressive, you definitely want someone on your side to make it there. We're already to the Augusta Rule. All right, awesome. Okay, so we're moving on.
Nick, just one more question from
sure.
Debbie Barnett. What if your child has another job as well?
That's a great question. Actually, that was something that reminds me. So yes, exactly. Right. So this is very fact specific and fact intensive. I've worked with clients who, their kid is full-time in college, plays a college level sport, and then also has another part-time job, but somehow we're claiming that they also work 20 hours a week in the business. This is ridiculous, right? Don't do that, basically, is the advice there. Is it has to be reasonable. So what's going to happen, right? In Lance's world, the auditor will look and they'll come back and say, wait a minute, there aren't enough hours in the day. it's not even plausible that this person worked that much for you because of all of the other documented activities they have. And that's the key, is the documentation, right? So we have to make sure that if you are employing your kid or you're employing another family member, it not only is it reasonable, but it's possible, right? It needs to objectively be possible that they were working the business. Otherwise, you're going to get tanked here. Lance, anything to add there?
No, I think you've got. I mean, look, people can have multiple part-time jobs, so I think that can be completely appropriate. But it's you've got to pay a reasonable amount of compensation for the work that they actually perform. So if like Nick said, if there's not enough hours in the day, then the auditor is not going to believe you. The auditor, just think the auditor is, trying to explain this to a scrutinizing friend, right? If they're not going to believe you, then there's no way the auditor is. So
right. And I mean, look, they might very well get testimony from the kid. I mean, what's he going to say? Right?
No, they may well. The auditors go out in the field and they have a job to do. They don't just look at paper that you provide. First of all, they have all kinds of information that from other computer systems that they can harvest behind the scenes that you don't even know. But then they go out in the field, they can interview the child, they can interview the neighbor, they can interview another employer, they can show up at the college, they can do all kinds of stuff. And if it's worth it, enough money on the line, they will.
Yeah. Yeah, absolutely. So, all right. So we're on the home stretch here. We want to touch on the Augusta Rule. We sort of tease this in the marketing. It is, again, it's another fancy or sexy strategy that you see online. Again, so does the IRS. Be wary, be concerned if you're going to use this rule. It is powerful because you can rent out your personal residence to your business for up to 14 days a year and recognize $0 in tax on that income, on your personal income. So how would it work? Well, so basically you would have your own house and you have a business, and your business is now going to host, let's say, an offsite, and you do these offsites quarterly. So it's, 3 or 4 days at a time every quarter. So let's call it 3 days so that we stay under 14 days, which is the critical element here. It needs to be less than 14 days or less than 15 days. So up to 14, but no more than 2 weeks. So if you do this, right, and you have a reasonable business reason to use your home. Again, that's the key, right? I've met people that own gyms or own manufacturing plants where they don't do those kinds of things. This is not a place where offsites happen. They're going to become very difficult to explain the business purpose for using your home when you have a giant manufacturing facility or you have a massive structure where you could also have these meetings, right? So there has to be a reasonable business reason for using your home. But it can be amazing, right? Because you can set a reasonable rental rate for a corporation to rent a private space, right? Set that rate. Let's see. So here we've set it at $1,500 a day, right? In our where I am, where we are, I'm in northern New Jersey. I don't know if we have people maybe from around the nation, but at any rate, in our neck of the woods, that's a pretty reasonable rate if you're going to rent a private place for your corporate event. That's probably about right now. Look, meals and stuff, that's going to be a different expense line. But what we're focusing on is really just the rental paid. So you, as the person, the business owner, do not pay any personal income tax on the rental expense that the business is paying you. And by the way, what did I just say? It's a business expense. So you can deduct that then from your gross income. So in this way, you can realize a really massive amount of tax savings by renting out your home for 2 weeks. And it's called the Augusta Rule because of the masters. The people living in Augusta during the masters want to rent out their home, right? And they want to rent it out to a business that is going to be renting it for 14 days or less, right? So these golfers effectively coming to rent their house or patrons, and they get that income for free. Basically, they get all of that income tax-free. It is just their money. Now, the downside to that is no expenses related to the rental are deductible. So you get the income for tax-free, but what the IRS in doing that takes away your ability to deduct any expenses related to the rental. So you can't deduct it in your personal, but at least you can get that income. Now, there are some rules, right? The house has to be your residence. It can be a vacation home, but it has to be your residence. It has to be in your personal name. It can't be held by the LLC. And what Lance is going to talk about next is we're going to talk about how pairing this with a residency strategy, especially in high income states, can be really powerful. So Lance, we'll leave it here.
Yeah, thanks, Nick. So I'll cover this real fast. I handle a lot of residency planning and state tax residency audit defense. New York is super aggressive in this area. New Jersey has the same rules. They are not as aggressive, but they look at these things. Surrounding states, Connecticut, Pennsylvania do as well. So real quickly, because when you're talking about crossing a state line, again, I do a lot of state and local tax work, whether you're a business or an individual, you suddenly have potentially new obligations. So when you're talking about changing residency or establishing, a foothold in another state or using a residence in another state, you've got to worry about how you're tax reporting in now the two jurisdictions. So there's three ways that a state with an income tax, and I'm going to do this in 2 seconds here, but that can impose tax. So the first is your domicile, what's your true home. So most of us, if you have one home, that's your domicile, right? If you have multiple homes, then it becomes a real analysis of which one is your actual home. And you can have real legitimate disputes about that. Often it's New York or New Jersey versus Florida, right? Because we're two high tax states and Florida's a no tax state. But if you are able to establish that you've changed your domicile from jurisdiction 1 to jurisdiction 2, you still have to worry about statutory residency. It's a completely separate test. Are you maintaining an abode in the jurisdiction, and are you in the jurisdiction for greater than 183 days? Why greater than 183 days? 6 months. So a lot of people think, oh, I'm in or out of the state for 6 months, and I changed my driver's license. It's far more complicated than that. That's not good advice. But so there's a domicile analysis, there's a statutory residency analysis, second test. And then if you're able to establish that you're change your domicile, you don't meet the statutory residency test, then if you're still, and this is important, because I see this a lot on the state side, if you're in a jurisdiction earning income, and this is where things could dovetail maybe with the Augusta Rule, in some ways. If you're in that jurisdiction and you're not a resident, but you're earning income in that state, you probably have state sourced income. So you've got to think, if my business is in New Jersey, my home is in Florida, and I'm traveling around doing different things, do I have filing obligations in those different states? Is it just no tax because I live in Florida? I'm not so sure about that. Let's look at New York's rules where your business is. Let's look at how much time you're spending in the other states and so forth. And then, perhaps maybe the Augusta Rule helps you at the federal level save some of that. But let's look quickly at where the Augusta Rule, there's a great case where the Augusta Rule came up. So the Javids, this poor family, it sort of combines all the things that Nick and I have talked about. They were there's a 23 case involving I think 14, 15, 16, 17 tax years. So the taxpayer was a salaried executive employee at a company, and he was making an income, full-time at that job, but he had a side hustle, a lot of problems, a lot of opportunity with side hustles, a lot of problems with side hustles. But he had this side hustle where he was at his full-time job, he was like a marketing and sales professional in the chemical industry, in the oil industry. And so he had a side hustle as a Schedule C on his 1040, sole proprietorship, where he was doing that on the side, sales and marketing, consulting in his related field. So that's all fine. But then he had his children were in college, and this side hustle was a family business. He employed his wife and 2 kids, or he allegedly employed them, and they were in college, to sort of tie in what Nick was saying earlier. Do they have enough time to work in the business as well? Well, he claimed that these people were, the children were. He would give them assignments and he would oversee them, and they were actually performing work, and that he was paying them for that work and so forth. And then so this is sort of what was going on. And then they consulted with an advisor. Unfortunately, the advice they got wasn't the best. And they got a very complicated structure or advice to change their structure and to take all kinds of certain advantages, which of course blows up in their face later. But so they take the Schedule C and they convert it into an S corporation, which we were talking about. Then they form another related C corporation, which is now paying marketing fees to the S corporation, although it's not actually, it's proven in the audit in the court, it's not actually doing much of a marketing for this other business. And in exchange for that marketing fee, it's now paying many of the expenses of the family, since it's a family business, including the college tuition, including the two kids went to two different schools, and the parents had bought houses for them to live in rather than in the dorms. So now they have these properties, and they were suddenly, instead of having like the meetings at hotels or at restaurants, now they were renting out these properties and trying to use the Augusta Rule or something like the Augusta Rule, short-term rental, 14 days. And so there's a lot going on to tie a lot of what we were talking about together. And the IRS comes and looks at this and says, we don't believe any of this, right? You did all this for tax reduction, which again is allowed. You're allowed to structure your affairs in a tax efficient manner. But the IRS looked at this and said, we think you went beyond that. We think the C corporation is a sham. We think all these expense deductions are not business expenses, which we talked about. We don't think the college children are actually employees of the business. And they go to court. The father, the primary business owner, testifies as to a lot of this. And the court thought he testified credibly that the kids were actually in the business, that this was a family business, that he wanted to pursue this, with them once they graduated college. At that point, because these things take a while, one of the children had already graduated and was now working for the business. So, some of this added up. Unfortunately, not everything added up. So almost all of these deductions were disallowed. The only ones that they were allowed were the ones related to employing the children. Everything else went sideways, and I think went pretty poorly for them in court in terms of owing the tax, the interest, and absolutely the penalties. So you have to be. We'll quickly conclude, and I'll turn it back to Nick. When you're doing these things, make sure you're working with someone who's honest and credible and knows the rules. Make sure you understand you understand what they're telling you. Make sure you feel comfortable with it, and make sure that you have all of the paper that is required that you have. And if you don't understand it, then to go back to your advisor or educate yourself or get a second opinion, because when the government comes and looks at these things, again, they're not your enemy, but they're certainly not your friend. They're not going to look the other way. It's their job to collect the tax, and they're going to.
And look, the overarching theme here of everything today is it's about your intent, right? If your intent was solely to avoid paying taxes, that's not going to fly, right? The intent has to be some real business purpose. There was an ongoing business. You were going to do it anyway, which is this is how I couch to my clients is, if you're going to do it anyway, if you're going to spend this money anyway, let's spend it, and let's do it in a way that is also tax efficient, right? Instead of, oh, let's do this because it'll save you on taxes. We should do these things because you're doing them in the ordinary course of business anyway, and these are additional strategies that will just help you save money by making those moves. So some audit trigger takeaways here, just, again, be smart, right? These are all lawful. Loopholes, gets a bad word. It's not a pejorative, right? It's not wrong. They're there. They're in the code. And again, proper planning, understanding the rules, marshaling the facts, so making sure you have all your documentation. And again, we'll close with consult a professional, right? So questions, comments, anything in the last sort of minute here. I know we came up on time, but please, if anyone has any additional questions, now is that time.
Or feel free to reach out afterwards. Both Nick and I, we really enjoy what we do. We like working with clients and clients professionals. So if you want to have a chat afterwards, absolutely, please reach out to us.
And it looks
This was fantastic.
Yes. Lucy, you have a question?
Yeah, well, first of all, I think somebody was saying fantastic, and I would echo that. Incredibly informative, incredibly timely. I would almost say we should consider doing this once a year at a minimum, every year in January. And I definitely want to follow up because this has triggered so much for me from a tax strategy perspective. And now I'm going into year 11 in business. And I'm just realizing potentially all the tax strategies I did not take advantage of in the first 10. So I want to make sure I'm better prepared for the next 10. So thank you both very much.
Yeah, Lucy, you know what? I get that a lot. I get a lot of people that come to me. They're like, oh man, I wish I've met you 5 years ago, 6 years ago, right? We can always amend, right? If you have the records, we can go back. Right now, that can come with some risk, But if we can
Okay.
prove it up and we are right, we can always amend and see if we can't get you some money back.
Got it. Got it. Thank you so much. Appreciate it.
Perfect. Any other questions? All right. Well, again, thank you so much, Nick and Lance. You did a wonderful job. And again, thank you all for joining us for today's session. If you have any questions, please feel free to reach out to any of us and enjoy the rest of your day. All right. Bye.
Thanks,
Have a
everybody.
great day. Thank you.
Thank you. Bye.